Right now, somewhere in Australia, there's someone staring at their bank account, proud of what they've built, but quietly wondering why it doesn't feel like progress. Maybe that's you. Maybe you've got $10,000, $15,000, even $20,000 sitting in a savings account with Combank, NAB, ANZ, or Westpac. You're doing the responsible thing. You're saving. And yet, something feels off. The number goes up, slowly, and the feeling of falling behind never quite goes away. What's happening? And more importantly, what's the difference between the people who are building real wealth and the people who are just waiting? That question changes everything, and the answer is simpler and more urgent than most Australians realize. Let's talk about the single most important financial shift you can make, the shift from saving money to actually investing it. Here's the core idea. Saving and investing are not the same thing, even though most people treat them like they are. Saving is putting money somewhere safe, a bank account, an offset account, under the mattress. It's about liquidity. It's about keeping what you have. Investing, on the other hand, is putting money to work. It's about growth. It's about building wealth that compounds over time and outpaces inflation. And here's where Australia makes this so easy to get wrong. The big four banks, Combank, NAB, ANZ, and Westpac, are some of the most trusted institutions in the country. Putting your money there feels responsible, safe, smart, and it is responsible for a portion of your money. But when all your money sits in a savings account earning 4 or 5% annually, before tax, before inflation, the real return on your savings is far smaller than it looks. Australia's Consumer Price Index has regularly pushed inflation above 3% in recent years. Once you subtract inflation and apply your marginal tax rate to the interest earned, that safe savings account is barely treading water. It's not building wealth, it's preserving it, barely. Compare that to the long-term average return of the ASX 200, Australia's benchmark stock index. Historically, the ASX 200 has delivered total returns, including dividends, of approximately 8 to 10% per year over long periods. That's not guaranteed. Markets go up and down. But over 10, 20, 30 years, the data is compelling. That's the difference between a savings account and an investment portfolio. That's the gap between stability and genuine financial freedom. So why don't more Australians make the jump? The psychology here is real, and it matters. Savings feel safe, especially with the big four banks. There's deposit insurance up to $250,000 per institution under the Australian Government Guarantee Scheme. The number on the screen never goes backwards. It never panics. It never crashes. Investing does all of those things, at least in the short term. And that's terrifying for a lot of people. There's also the entry barrier myth. I need thousands of dollars to start investing. Wrong. That used to be true. It isn't anymore. Modern Australian platforms have changed everything, but more on that in a moment. And then there's the most dangerous belief of all. I'll start later. Later, when I have more money, when the market calms down, when things feel less uncertain. But here's what the data tells us about later. Every year spent on the sidelines is compounding that someone else is doing. Compounding is ruthless. It rewards early starters and penalizes procrastinators. There's also Australia's unique cultural obsession with property. For generations, investing in this country meant one thing: buying a house. And while property can be an excellent investment, it's created a mental block where shares and ETFs feel foreign, risky, or somehow less legitimate than bricks and mortar. The reality is that both asset classes have a role to play, and for many Australians, shares and ETFs are far more accessible than a deposit on a Sydney or Melbourne property. So how do you actually make the transition? Step by step. Step 1. Build a real emergency fund first. This is non-negotiable. Before a single dollar goes into the market, Australians need 3 to 6 months of living expenses sitting somewhere accessible, not in the market, not in super, in a high-interest savings account, somewhere like ING, Macquarie Bank, or UBank, which have consistently offered more competitive rates than the Big Four. Or if you have a mortgage, your offset account is an excellent home for emergency funds. Why does this step come first? Because without an emergency buffer, any market volatility becomes a personal crisis. If the ASX drops 15% and you need cash urgently, you might be forced to sell at exactly the wrong time. The emergency fund is the foundation that makes everything else possible. This money is not for investing. This money is your financial immune system. Step 2. Separate your money mentally and physically. Think in buckets. Bucket 1 is safety. That's your emergency fund, short-term savings goals, a holiday, a car, a rental bond, and anything you'll need within the next 1 to 3 years. Bucket 2 is growth. That's your investment capital, money you won't need for at least 5 to 7 years, ideally longer. And then there's a third bucket that most Australians completely ignore: superannuation. Your super is already a growth bucket. It's already invested, it's already compounding, often in an ASX and global shares portfolio, and most people have no idea what it's actually doing for them. More on that soon. The power of the bucket system is psychological as much as financial. When everything is in one pool, one savings account, every purchase feels like it's competing with your future. But when money is sorted into clear roles, decisions become easier. This comes from growth, this comes from safety. That clarity is transformational. Step 3. Start investing in Australia and start small. Here's the myth-busting moment. You do not need $10,000 to start investing in Australian shares or ETFs. Platforms like Pearler, Stake, SelfWealth, and even ComSec have dramatically lowered the barrier to entry. Some allow you to start with as little as $50 per trade. Others offer fractional investing options. What should a beginner buy? For most Australians who are starting out, exchange-traded funds, ETFs, are the obvious answer. Specifically, ETFs that track broad indices like the ASX 200 give exposure to the top 200 Australian companies in a single trade. Add a global ETF, one that tracks the MSCI World Index or the S&P 500, and you've got diversified exposure to the Australian and global economies in 2 products for minimal cost. These aren't exotic instruments. They're simple, they're low fee, they're transparent, and they've outperformed the majority of actively managed funds over the long term. The investment industry doesn't love talking about that fact, but the evidence is consistently clear. Start with $50 to $200 a month. The amount matters less than the habit. The habit of consistent automatic investing is the single greatest financial behavior change most Australians can make. Step 4. Keep it simple. This step might be the most important of all. The financial media has a vested interest in making investing feel complicated. Every week there's a new hot stock, a new macro threat, a new prediction about where the market is heading, and it's tempting to engage with all of it, to feel like you need to be watching, adjusting, rebalancing, trading. You don't. In fact, for the vast majority of everyday Australians, more activity means worse outcomes. Day trading loses money for most participants. Individual stock picking consistently underperforms index funds over long periods. Crypto speculation is a different conversation entirely, but applying a gambling mindset to any investment is a trap. The evidence for low-cost, broad-market, index-based investing is overwhelming. Even the most sophisticated institutional investors struggle to beat the index consistently after fees. A simple ETF portfolio, ASX exposure plus global exposure, is not a beginner's compromise. It's a sophisticated, evidence-based strategy. Step 5. Consistency beats timing, every time. Dollar cost averaging. Putting a fixed amount into the market every month, regardless of what prices are doing, is one of the most powerful and underappreciated investing strategies available. Not because it's complicated, because it's simple and consistent. Think about what that looks like over time. $300 per month invested consistently into a diversified ETF portfolio with an average annual return of 8% over 20 years becomes approximately $176,000. Over 30 years, it approaches $440,000. These figures are approximations and depend on market performance, but they illustrate the extraordinary power of time in the market. And here's what the data reinforces repeatedly. The biggest gains often happen in short bursts that are impossible to predict. Missing even the 10 best trading days over a decade can dramatically reduce your total return. The strategy that consistently works? Stay invested. Don't try to time the market. The market rewards patience more than it rewards cleverness. Step 6. Market drops are normal, and they're not your enemy. Every Australian investor who started before 2020 remembers the COVID crash. The ASX 200 fell approximately 36% in less than a month in early 2020. It was terrifying. And then, within 12 months, the market had recovered and surged to new highs. Investors who stayed in, or better yet, kept buying during the dip, were rewarded spectacularly. Investors who sold in panic locked in their losses. Fast forward to 2022, rate hikes from the Reserve Bank of Australia sent share markets lower globally. The narrative was grim: inflation, recession fears, cost of living pressure. And yet, for investors with a long-time horizon who kept their monthly contributions running, those were discount months. Lower prices mean more shares per dollar. More shares mean more compounding later. This reframe is everything. Volatility is not a bug in the investing system. It is the system. Drops are the admission price for long-term returns. The behavior that separates investors from panic sellers isn't superior knowledge, it's superior emotional discipline. Step 7. Superannuation is already investing, and most Australians are sleepwalking through it. Every working Australian has superannuation. The mandatory employer contribution rate sits at 11.5% as of 2024, heading to 12% in 2025. That's money going into an investment account on your behalf every single pay cycle. For most Australians, super is the single largest investment they'll ever have, and most people have no idea what it's invested in. Your super fund is investing your money right now in Australian shares, global shares, property, bonds, and other assets. The question is, are you in the right option for your age and risk profile? Most funds default members into a balanced option. For younger Australians with decades until retirement, a growth option with a higher allocation to shares has historically produced better long-term outcomes. The difference over 30 years can be enormous. It takes 15 minutes to log into your Superfund's member portal and check what investment option you're in. That 15 minutes might be worth more than any other financial action you take this year. You're already an investor, you just might not be paying attention.